Hi, everyone. Thanks so much for coming out. It's a pleasure to be here. So this program was initially done at the law school, just among a small group. And the dean enjoyed it so much that Lisa Broom took her own initiative to start the ball rolling to bring this topic, Think Fast, to the broader university community. And we thank her very much for that. It's sort of a combination between the School of Law, Business, and Economics, so we're going to hear all kinds of perspectives this evening on what exactly is going on. We do have a limited, tight schedule, and we've got a lot of very smart people who are used to talking for at least 55 minutes. So I have my handy stopwatch here. If you see me flailing from the audience, it probably means your time is up. Also, again, the reminder, you can put your questions on a note card, and we will be taking as many of those questions as possible, and the goal with the stopwatch is to get everyone's question in. So, without further ado, as was said once before, also just wanted to mention that there is a handout if everyone wants to have a bio in front of them as people talk. It is available just outside, and you should have received one when you came in. So let's get to our first speaker now to start this. We'll have Jennifer Conrad speak first. And Jennifer is the Dalton McMichael Distinguished Professor of Finance at Kenan-Flagler Business School. And she's going to be also sharing the stage with Chris Lundblad, the Edward M. O'Haron Distinguished Scholar and Associate Professor of Finance. And again, more on their bios in your handout.
Well, thank you very much. Thanks for coming. So it's odd to start a talk to a very general audience with a picture like this, but this is very much the point, actually, which is complexity. And this is sort of basically a primer on what we're dealing with right now from the standpoint of the securitization side of all of this. And I just want to give you this to give you a flavor of the challenges that we're facing and what's sort of a little bit different now from what we've seen in the past. So one piece of the puzzle, you know, if we all sort of went and got mortgages historically, you'd go down to the corner bank, you'd get your mortgage and pay it back, and presumably the bank may very well sit on that mortgage for the entire term of the loan. Those days are long, long gone. And instead what happens is those mortgages get packaged into pools and sold off to other investors in pieces. And much of what we saw late was an explosion of that kind of facilitation in the subprime space. So who's a subprime guy? Well, that's somebody, if you look here in these blocks, that sort of maybe scored poorly on the credit dimension, and maybe had a bad loan-to-value ratio on the loan so that they had sort of a low down payment. And what would happen then is we would collect all of those various loans that satisfied that classification together, consolidate them, pool them, and the way that this was done was to put them into tranches, which were delineated basically by credit quality. And what would happen then is invariably some of these subprime loans would default, and the losses there associated with that default would first accrue to those people that were lowest in this credit spectrum, those furthest down this ladder. And those indeed were the ones that we're hearing about today as being toxic. Those shares are the ones that were the first hit in the instance of this kind of default. And then if we sort of move up the credit quality, the people higher along are only going to get hurt if there's a huge amount of defaults over here on the top level. So this already is sort of complex. It's securitization. We've seen it for some time. But here it has an additional complexity in that it's related to some subprime stuff, which I'll talk about more in a moment. And additionally, a lot of these things, as were many, many others, they were spun off into subsequent pools and collected with pieces from other parts of the financial space. And that's where you're seeing CDOs and CDO squared and all of the various acronyms that have become four-letter words today, effectively. And so the punchline here is complexity. You may have end investors, which are very, very far removed from the original instruments that we were sort of talking about. Additionally, you may also not really understand the full exposures of the counterparties in this space, and all of that makes things a bit complicated. Now, what did this do? Well, it did, on the one side, increase the capital base for mortgages in a large degree, and we saw a tremendous run-up in housing prices as a result of that. One, this is from Robert Shiller, the now famous economist webpage, a run-up in housing prices that's basically unprecedented in our modern history. And this is, again, is partially fueled by the increase in the credit, increase in the capital base, and it's also important in terms of its feeding back onto that, which I'll mention in just a moment. So this is incredibly important, and what you see in that little dip down has accelerated in more recent months, and now we see housing prices being off 20 to 30% in certain parts of the country. So how big was this market, subprime, this particular component? Well, what I have here is basically a table that describes how much of this kind of thing was going on. And if you look at overall mortgage origination in this country, we're talking about $2-3 trillion bucks over here. That's sort of goes around a bit through time. But what you see is a dramatic increase in the next couple of columns for the role for subprime in that space. So we're talking about subprime making something like 8% of mortgage origination all the way up to about a fifth. Once this game was kind of reaching the end in 2007 is when everything really started to slow down. So not only is subprime a bigger part of the game, but it is also largely being securitized by the end of all this. So the last two columns tell you how much of that subprime stuff was indeed securitized. And by the end, about 80% was securitized. So these kinds of instruments are really floating around out there big time. And what's quite different here for subprime is that many of these loans were constructed in the following way. They were given a very brief teaser rate, where you'd have a low interest rate for a few years, and then that would eventually balloon into a much larger number. And the only way that that could fly for a subprime borrower that's not going to be able to facilitate that larger interest rate at the end of the day is if they can refinance at some later date. And the only way that they can refinance at some later date is if the house that they've purchased has gone up in value. So if the house goes up in value, what can they do? Well, they can capture that equity, refinance, effectively use that as a down payment, and now they may no longer be technically subprime. Without which there is nothing there is the house price going up. Well, housing prices slowed, eventually started to recede, and now we saw this explosion in delinquencies over here. And that's exactly what we're getting, is this explosion in delinquencies. Foreclosures are starting to amass from all of this. And the problem is the folks that are left with the bag here are the banking sector and other players in the financial industry. And it's indeed this that we're starting to see sort of permeating the entire finance side and eventually even the economy, because folks are dealing with all of these complex instruments, layers upon layers of stuff. That's sort of originating here in this mortgage industry. So now what do the banks do? Well, I'll turn it over to my colleague who's going to give you a sense of what it is the banks are struggling with and how we can proceed.
So Chris has described in a little bit of detail the securities that are at the heart of this crisis. He's talked about their complexity, which is a word that I want you to remember, and he's talked about the size of the market. And so we come to the end of 2006, and we're moving into 2007, and a number of banks have a lot of dollars tied up in these assets on their balance sheets. And the asset values that they have on their balance sheets start to decline. And we already see in the data that Chris showed us why these asset values started to decline. The first reason is that the asset that supported everything here at the house values started to run down in value at the end of 2006. Of course, that decline in value accelerated through 2007, is continuing to decline in 2008. And then the payments to these securities started to go down as well. And you can see that in the uptick in the mortgage delinquency rates, again, starting in about 2006. So what would you expect a bank or a number of banks to do when they're looking at these this drop in the asset values on their balance sheets? Well, the first thing they'd have to do is to acknowledge the drop in values. And one of the ways that they can do that is to write down the assets on their balance sheets or potentially sell those assets. And if the hole that is created when they write down those assets or when they sell them is sufficiently large to maintain their capital ratios, they might also have to raise equity. Now, those two transactions, selling the assets and raising the equities, require a functioning market. And the market did function. I mean, as late as July of 2008, Merrill Lynch was able to sell some of these assets off their balance sheet, maybe not at a price that they would have wanted, at about 22 cents on the dollar, but they were able to do it, and they were able to raise equity on that same day. But asset values continued to decline, and then something else started to happen, and that is that markets started to fail. And there are some conditions under which markets can fail. And I wanted to talk about those conditions, and I wanted to talk about them in the context in which the paper that originally talked about this problem did so. I'm going to use the example. Well, the paper's called The Market for Lemons, and it starts out something like this. So you want to buy a used car, right? And you go down to the used car market. I'm going to put that in air quotes. And you're looking at all these used cars, and they just look great. They've been detailed, their exteriors are immaculate, but of course you know that what really matters with a used car is what's under the hood. And you also know a couple of other things, and that is that there are big differences in quality in what's under the hood with used cars. And you know that you have at best an imperfect ability to assess those differences in quality. And so let's say for the purposes of my example that used cars can vary in value because of those differences in quality from $0 to $10,000. And let's work through the process that you would go through in trying to come up with a bid for a particular used car. One thing that you might say, think of it as round one, is that if I pick a random car off this used car market, that if I bid the average value, say $5,000 in this example, that on average I won't be taken advantage of too badly. I might get a car, again randomly, that's worth a little less than $5,000, but I might get a good car. And so on average, I'll be okay. Well, for every transaction, remember, there has to be not just a willing buyer, but a willing seller. And so think of this as round two. You've thought about putting in a bid of $5,000, and now the second problem raises its head. And one of the things you might worry about in the used car market in particular is that the sellers of the car might look at your bid of $5,000 and they might know more about the value of their car than you do. They have, after all, been driving it around for the last few years. And so in this scenario, the person who thinks that their car is worth $8,000 is not going to come to the market for you with your bid of $5,000. And so now what's happened, bad cars have driven good cars out of the market. You say to yourself, I can take care of that. I can drop the bid for a used car. So you think about dropping to $2,500. Still, the seller is likely to know more about the value of the car than you do, and they're going to pull now cars that are worth $3,500 off the market. And so now bad cars have driven not so good cars out of the market. And in the end, if these problems, if these conditions are met, the market can fail. What are the two conditions I talked about? Difference in quality across the assets. Is that condition met in the market for these securities that Chris talked about? Well, think about that first picture that he put up that is quite scary to look at. Those assets are so complex that they have huge differences in quality across them. They have different mortgage originators, they have different vintages, they have different geographies in the mortgage that are backing those securities. So I think we can check off that first condition. And what about the second condition? The seller had to know more than the potential buyer of these assets. Well, these banks had been driving these mortgage-backed securities around for a while, potentially. In fact, in a lot of cases, they built the pricing models that enabled them to have these issued in the first place. So the second condition also became a concern. And in those conditions, if there's not enough trust in the marketplace, the market's going to fail. And so eventually banks aren't going to be able to either sell the assets or to raise equity. And when you have a lack of trust, which is what this is, then banks, it turns out, are peculiarly sensitive to a lack of trust. What do banks do? When we walk into a bank and we hand it some money and we open up a demand deposit, what the bank does is it offers us a commitment that we'll store your money for you and we'll give it back whenever you want. So that promise from the bank to us is very, very liquid, right? We can walk in and get our money whenever we want. What does the bank do with the money that they take from us? They take some of that money and they give it out as loans. But the loans that they give out don't have that same liquid feature. They can't go back to the borrower and say, we want our money back now. So there's a mismatch between the liquid liabilities that banks use to fund themselves and the illiquid assets, the loans that they have on their balance sheets. Most of the time, this mismatch in liquidity doesn't bother us as depositors because we're all not going to rush to the bank's door at the same time to get our money back, unless we're a little worried about the bank's stability, right? In that case, we might think about trying to ask for our money back from the bank, even if we're not worried about the bank's stability, right? Even if we're the rational ones on the block, what we might worry about is the other depositors at the bank. And if they're all going to be worried about the bank's stability, then we might want to get ahead of them in line to ask for our money back. And so in that case, you can have a run on the bank. And anyone who's seen It's a Wonderful Life will remember that quite vividly. Now, of course, deposit insurance has taken the probability of a run on a single bank kind of off the table, not quite. But there's another situation with banks that can also create a similar crisis, and that is other lenders to the bank. And so if other lenders to the bank are worried about the safety of their money, then you can have lenders in this situation who might also create a run, not just on an individual bank, but a run on the banking system. Did we have those conditions in this market? Well, if you take a look at lending rates between banks, and here's an interest rate that you might heard of lately. This is the London Interbank Offer Rate, or LIBOR. You can see that we have spikes, particularly recently, in the rates that banks would charge other banks to lend to them. So it's not necessarily just the depositors that we need to worry about, it's other lenders to the bank. And if these overnight markets don't work, then banks are not going to be able to make those productive loans, and it's going to have effects on the real economy. Okay? And so I think Lisa's up next, and she's going to tell us a little bit more about bank runs.